Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at AlgoBot, and today we're exploring a mean reversion approach called Liquidity Vacuum Thrust Fade. This strategy studies market microstructure, specifically how far price travels for each unit of trading participation. By the end of this video, you'll understand the price impact idea that drives it, how it identifies a thin, overstretched move, and how it aims to fade that move back toward a fair value baseline. Remember, everything here is educational information only, not financial advice. Let's dive in. Let's start with the big picture. Liquidity Vacuum Thrust Fade is a mean reversion expert advisor for MetaTrader 5. Instead of following momentum, it looks for moves that appear exhausted and aims to trade against them, back toward what it treats as fair value. The idea at its heart comes from market microstructure. A price move only carries weight if genuine participation pushed it there. So the strategy measures price impact, how far price traveled for each unit of tick activity on every closed bar. It divides the size of the bar's price change by that bar's tick volume. When a large directional move prints on unusually low tick volume, the strategy reads that as a liquidity vacuum. Price has slid through a thin order book with very few participants, so there is little committed inventory to hold the new level. Historically, moves like these tend to snap back toward the mean once normal two-sided flow returns. To measure this, the strategy takes a rolling window of impact readings, calculates their average and standard deviation, and z-scores the most recent bar. A high z-score means this bar moved a lot on far too little participation, the vacuum signature. A rolling simple moving average acts as the fair value baseline and the take-profit target, while the average true range measures how stretched price has become and sets the protective stop. This approach is designed for liquid markets, major foreign exchange pairs, or a broad index, on intraday timeframes from 5 minutes to 30 minutes, where thin off-peak moves and brief overshoots tend to revert. It may appeal to traders who are curious about volume-aware, contrarian, mean reversion logic. As always, this is educational information only, and trading carries real risk, including the risk of loss. Now let's walk through the mechanics step by step. The expert advisor works on closed bars only, so it evaluates a signal once each time a new bar completes. First, it builds the price impact measure. For each closed bar in the window, it takes the absolute change from the previous close to this close, and divides that by the bar's tick volume, using a floor of 1 to avoid dividing by 0. That gives impact, distance traveled per unit of participation. Over the rolling window, which defaults to 30 bars, it computes the mean and standard deviation of impact. Then z-scores the most recently closed bar. If that z-score is below the threshold, which defaults to 2, nothing happens. The bar simply was not thin enough to qualify as a vacuum thrust. A high-impact bar on its own is not enough, because a quiet drift also has few ticks. So 2 more conditions must line up on the freshly closed signal bar, both measured against the moving average baseline. For a short setup, the thrust must have been upward, the bar closes bullish, and it must have left price stretched at least the minimum stretch amount, in ATRs, above the baseline. The default minimum stretch is 1 ATR. When all 3 align, a bullish thrust, enough stretch above the mean, and a qualifying impact z-score, the strategy signals a sell. It targets the moving average baseline as the take profit and places the protective stop 1 ATR band above the entry, scaled by the stop multiplier, which defaults to 1.5. For a long setup, the mirror image applies. The thrust must have been downward, the bar closes bearish, and price must be stretched at least the minimum amount below the baseline, with the same qualifying impact z-score. The strategy then signals a buy, targeting the baseline as take profit and placing the stop 1 ATR band below entry. Before any order is sent, several filters apply. A minimum reward to risk filter, defaulting to 0.8, rejects setups where price is already so close to the baseline that the target cannot justify the stop distance. A spread guard blocks entries when the current spread is wider than the allowed maximum, and only 1 position per magic number is held at a time, so the ATR stop and the moving average target manage every exit on their own. There is no separate trailing logic. The trade simply runs to its stop or its target. Let's look at the actual meta editor code that runs this logic. At the top are the input parameters you can adjust in the strategy tester. Impact period sets the rolling window for the impact z-score, defaulting to 30. ImpactZThreshold is how many standard deviations of impact a bar needs to count as a vacuum thrust, defaulting to 2. SMA period is the fair value baseline and take profit lookback. MinStretchAtr is the minimum distance from the baseline in ATRs. ATR period and AtrStopMult control the volatility measure and the stop distance. Min reward risk sets the minimum reward to risk ratio, and max spread points is the spread guard. Lots and magic set the order size and the identifier. Now the two signal blocks. The short block fires when the bar is bullish and above mean is at least the minimum stretch, meaning price closed far enough above the baseline. Inside, entry is taken at the bid, the take profit is set to the SMA, and the stop loss is the entry plus the stop distance. If reward and risk are both positive and the reward to risk ratio clears the minimum, it calls trade.sell with those stop and target levels. The long block is the mirror. It fires when the bar is bearish and below mean is at least the minimum stretch, so price closed far enough below the baseline. Entry is taken at the ask, the take profit is again the SMA, and the stop loss is the entry minus the stop distance. After the same reward to risk check, it calls trade.buy. Notice that both sides point their take profit at the same baseline. The moving average is the magnet that every fade aims for. Let's bring this to life on the chart. On price, you can see the moving average baseline weaving through the candles. That's our fair value magnet and the take profit target for every trade. Below the price panel is the price impact z-score, our participation gauge, with a dashed threshold line at 2 standard deviations. Watch what happens as the candles develop. At the far left, price hovers quietly around the baseline. The first couple of candles are small and balanced, sitting close to the moving average. The impact z-score stays low, while under the threshold, so the strategy simply waits. There is no overstretched move and no thin participation to fade. Then comes the third candle, and the character changes completely. Price drops sharply lower in a single bar, closing bearish and well below the baseline. This is the downward thrust the strategy is built to notice. But the key detail is in the subpanel. As that bar completes, the impact z-score spikes up and pushes above the dashed threshold at 2. That tells the strategy this steep drop happened on unusually thin participation. A lot of distance traveled for very little tick volume. It's a liquidity vacuum flush. Price is now stretched more than the minimum ATR distance below the baseline. The bar closed bearish, and the impact z-score has cleared the threshold. All three conditions align, and the buy entry marker prints. The take profit is set at the moving average baseline above, and the protective stop sits 1.5 ATR below the entry, just under that fresh low. Notice the reward to risk filter has already checked that the distance up to the baseline is worth at least 0.8 times the stop distance. Over the next couple of candles, normal two-sided flow returns. Price recovers off the low, climbing back candle by candle toward the mean. By the time we reach the take profit marker, price has closed the gap and tagged the baseline. That's the long trade complete. The fade caught the snapback from the thin flush to fair value. Meanwhile, the impact z-score has already settled back down below the threshold. Now the market goes quiet again. Several candles drift sideways, hugging the baseline, and the z-score stays subdued. The strategy holds its fire. There's nothing stretched or thin to act on. Then the mirror setup appears. Look at the tall candle that surges upward, closing strongly bullish and well above the baseline. This is an upward thrust. Again, the subpanel is where the confirmation lives. The impact z-score jumps and pushes above the 2 threshold as that bar closes. Price raced higher on very little participation, the same vacuum signature, just in the opposite direction. Price is now stretched more than the minimum ATR distance above the baseline. The bar closed bullish, and the impact z-score has cleared the threshold. The sell entry marker prints. This time the take profit sits at the baseline below, and the protective stop is placed 1.5 ATR above the entry, just over that high. The reward to risk filter again confirms the move down to the baseline is worth taking relative to the stop. From there, the thin push runs out of steam. The following candles roll over and price eases back down toward the mean, candle by candle, until it reaches the take-profit marker at the baseline. That completes the short trade, a fade of an overextended, thinly traded pushback to fair value. Step back and you can see the rhythm. Both trades share the same shape, a sharp, thin, overstretched move away from the baseline, flagged by an impact Z-score above the threshold, followed by a fade back to the moving average magnet. The stop always sits one ATR band beyond the extreme, and the target is always the baseline. That symmetry, thin thrust out, revert back, is the entire idea in a single picture. That brings us to the end of our look at liquidity vacuum thrust fade. We covered the price impact idea at its core, how the strategy Z-scores each bar's participation to spot a thin, overstretched thrust, and how it fades that move back to a moving average baseline using an ATR-based stop and a reward-to-risk filter. We also read through the actual meta-editor code and walked a long and a short example on the chart. Remember, everything in this video is educational information only and not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do occur. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.